All right, we hit the recording button and we're going to go ahead and get started. So welcome to our second quarter 2014 review for Francis Financial. We're excited here to give you our crystal ball forecast for the upcoming couple quarters, in fact, even the upcoming couple years. Before we get started too quickly, I'm going to go ahead and give you a little bit of background, tell you a little bit more about Francis Financial. Francis Financial is a very special firm. We are a boutique wealth management firm. We are dedicated to providing individuals like yourself with specialized financial guidance. Our fee-only approach promises objectivity in our recommendations and also our services. Quite a few people come to us because we're known for working with women going through divorce and post-divorce. We have many clients that we've been able to help during difficult times, such as losing a spouse. And we also work with many happily married couples as well. We have some exciting news, and we just received quite a few awards. We just received the Women's Choice Award for all the financial firms out there. We received that in 2014. Last year we received our Pro Bono Award, so the top pro bono firm out of the entire country. That is partially for our efforts of supporting Savvy Ladies, which is a nonprofit to teach women about money. I founded that charity a little bit over 11 years ago. We received an award from Medical Economics, another one from Smart CEO. So we are on a real roll and have had a phenomenal year so far. So with that, I know that you're here to get that crystal ball forecast to better understand what you should be doing with your portfolio. Where should you be looking going forward? And with that, let me go ahead and get us started making sure that you have all the information that you need to be able to make smart decisions. So first we're going to talk about our quarterly review. What happened in the past? That has an impact also on our investment outlook looking forward. And then also, what portfolio positioning do we have to really take advantage of that, the market positions that we're in right now? So our quarterly review, essentially, what we have seen during the second quarter, U.S. stocks rallied significantly over this last second quarter, partially because we saw some very positive investor optimism with historic highs. Now there was definitely some tailwinds, some headwinds. Essentially, economic growth was subpar during this time. I'm sure many of you remember that the GDP numbers were revised, unfortunately, downwards. The terrible storms and the cold that we had over the winter. Not was it just uncomfortable. I mean, I have to tell you that this was one of the first years that my kids actually didn't go to school, not because there was so much snow on the ground, because it was so cold. While not having school, days being canceled, we found that it had a big impact, a negative impact, unfortunately, to consumer spending, and even has trickled down, of course, that we see in corporate profits. There's continued uncertainty somewhat from the Federal Reserve about their plans going forward of whether or not they'll be raising interest rates. So that uncertainty also is another headwind for us. What's interesting, though, the markets seem to have somewhat not cared. And as I mentioned, the U.S. Stock market has gone up significantly. The second quarter, large cap stocks went up about 5.9%. We also saw some really nice gains in the international market. So developed international is UK, Canada, Germany. We saw some really nice growth there, 4.45% just in the last quarter. And emerging market stocks. Emerging market stocks, as you know, had a little bit of a downturn towards the end of 2013. Well, guess what? They've come roaring back. And emerging market stocks posted some phenomenal gains during the second quarter, 7.32% of gains, just again in a 3-month period, which is phenomenal. So overall, we're seeing some fantastic gains, both in the U.S. Developed international as well as emerging market stock market. How about core bonds? Now, core bonds we've been talking about. Core bonds, we've been talking about this story for quite some time, and concern in particular, as individuals are concerned about interest rates rising over the next couple years, there's been somewhat of a flight from bonds to stocks. Has it been a good place to have your money? Well, interestingly enough, for the last quarter, not such a bad place. In fact, if we look at municipal bonds, they were up 2.25% just in the last quarter. That's phenomenal for a bond, and also U.S. intermediate term bonds, high quality credit bonds. Those were up almost 2%. So I have to say, it was a phenomenal quarter, both great for bonds as well as great for stocks. The question that many people have is what's going to happen going forward? In particular, concerns about with the stock market at what we consider from many parts of the market at real frothy levels. Are we expecting the market to continue? And what about bonds? What should you be doing? Bonds, many people are concerned about interest rates rising. When those interest rates rise, guess what? Bond prices go down. That's a fancy way of saying that you're going to lose money. What happens? So let's talk a little bit about where we've been and where we're going to go. So despite this soft patch that we saw this last winter, the economy has really continued on this nice, slow path of recovery from the financial crisis. And we've put together this wonderful chart that you see in front of you. If you go back here, I'll start all the way in September 2007. So September 2007, you'll see what the expansion looks like, and you're going to follow the darkened blue line. Now, that darkened blue line represents our current expansion, our current recovery. And what we've done is we've placed over it in dotted lines different beautiful colors. I love colors. My daughter actually loves this chart. She doesn't quite get it. She's only 5 years old, but she loves the beautiful colors because we have our orange dotted line that is covering the 1991 expansion. We've got a baby blue covering our 1982 expansion, a really nice purple color dotted covering our 1980 expansion. We have a green, a darker green evergreen 1997 expansion. And then finally we have our light red, my daughter would call it pink, 1970 expansion. So what we've done is we've overlaid these expansions and the magnitude of these expansions over what we're currently seeing. And I think what you're gonna see is that for almost all the expansions, they've been much quicker, much faster than what we're experiencing today when you look at the overall growth of the economy, which is GDP. So that is something that we have seen and that we actually, going forward, expect to see. Continued recovery, that is, but much slower. And as you can see, much more slowly of an expansion than we saw in the past 6 expansions historically. So what does that mean for us? What does that mean for our investment outlook? Well, we have 3 different cases. We have our bull case, and I'll tell you, I would love to believe in this case. In fact, our offices, if you haven't been to them, we're at 1730 Broadway. We're literally 1 block from the famous bull statue. And I chose this office for many reasons. But one of them was because we were so close to that bull. And I figured, you know what? Any help, I'll take it. But essentially what the bull case is it's essentially a U.S. economic growth that is above average, and that this is helped by also strong non-U.S. growth. So this means that it's not only growth here in the U.S., but also growth internationally, that we would be seeing a much, much quicker expansion. Back to what I showed you on this chart, that's not what we've been experiencing historically. What we are experiencing is more of what we call the base case. Now, the base case is more of a moderate recovery. It continues. There's no major necessarily economic crisis. We don't expect there to be a big downturn. There might be a little bit of a normal recession of what you would expect every 5 years, but we don't see any negative downturns that are significant or prolonged. And gross domestic product, the overall growth of the economy, we expect that to continue at a moderate rate, and interest rates start to normalize, start to go up. And then there is the bear case. The bear case is what what we all worry about. And this is that the economy falls into a significant recession, and it could be for many different reasons. It could be deleveraging, inflation, shocks from Europe or China. Essentially, this is something that we worry about. It's, however, not something that we expect. And back to that, it comes down to, well, which of these scenarios is the most likely? What are we experiencing now? Is it the bull case? Is it the bear case? Actually, what we see from our models is that we're definitely experiencing the base case. So it's more in the middle, which is not necessarily a bad thing. It just means that the lofty, frothy returns, the high returns that we've seen from the stock market, both the international stock market and U.S. stock market, the magnitude of those returns we don't necessarily expect to be the same over the next couple years. So how do you really take advantage of this? Well, there are some ways that you definitely can, and investing in good quality stocks is part of them, and that's what we do here at Francis Financial. Why is that important? Well, there are a lot of positive things going on, and what we're seeing is that the consumer is actually spending money. Now, I would have been concerned about this back in 2009 when the overall fundamentals of your average consumer was quite weak. But things have changed, and actually the story for your average consumer, the story has become much better. So I really invite you to take a look at this chart. We put this chart together for you. It goes back all the way to 1952. And you can see the household debt as a percentage of disposable personal income versus household debt as a percentage of GDP. So the blue line, again, it's debt versus how much money people make. So the amount that someone owes on their credit cards, mortgages, car loans versus how much money they make each year. The second piece of that, household debt as a percentage of GDP, is the debt, again, as I mentioned, mortgage, credit cards, car loan, as a percentage of the gross GDP, the gross domestic product of the United States. So what does this story tell us? What this tells us is that individuals have been paying off their debt at very quick, rapid paces. And according to our metrics, the ratios that you can see here over the last couple of years have continued to improve, actually at a faster pace than we had really anticipated. Essentially, what this is showing is that the average consumer is in a much better financial position than they've been in a long time. They pay down debt. They have higher income versus the amount of money that they have in debt. It's really a good story, a good story. How is this happening? Why is this happening? Well, there are a few pieces. Number one, the unemployment rate continues to improve. Now, we're not necessarily where we want to be long-term for unemployment, but we're approaching our 66-year average for unemployment. So our 66-year average for unemployment is an unemployment rate of 5.8%. And that's actually represented in this chart that you can see that straight dark line all the way across the middle of your page. That is the 66-year average for unemployment, 5.8%. We went all the way back to 1948. Now you'll see the blue line, it really is up and down for many different time periods. But I invite you to go all the way to the far right of the corner of the chart and look at 2008. 2008, you saw massive increases in unemployment at such lofty levels that we had not seen for many, many years, up around approaching 10%. And what we've been able to do is slowly over time, we've been able to whittle that back. In fact, the current unemployment rate of 6.1% is the lowest reading since September 2008. So since September 2008, we have not had such low unemployment numbers posted. This is a really good number. And just so you have a little bit of background, this is from the U.S. Bureau of Labor Statistics, and it's dated actually quite recently. All the data that we poured into this model is as of June 30th, 2014. So again, the unemployment story is good. It's improving, and people are getting back to work, and they're using those earnings to pay off debt and put themselves in a better situation. The private sector balance sheet continues to strengthen. Essentially, what this is saying, this is a fancy way of saying that household net worth edged up to another record high. In fact, the record high we met $81.8 trillion in the first quarter. This was after bottoming out in 2009, where and essentially since 2009, household net worth has increased by 47%. So let's go back down to what we saw in 2009. Right here, essentially on the right-hand side of your chart, you saw a big drop after 2008 where household net worth, that is essentially the value of your assets minus the value of your liabilities or debt. You saw that it was a significant drop in value as people's homes were worth essentially revised to be worth less than previously. You saw massive drops in the stock market, again hurting and making their household net worth lower. Since then, we've had a really nice march upwards, and as I mentioned, that unbelievable figure of a 47% increase over these last couple years. It has definitely helped that stocks are doing better. Definitely has also helped that we see real estate, it has come back. And also the hard work of the average American to put themselves in a better situation and pay off household debt. So we're in, again, as I would say, a much more financially sound situation than we have been in many, many years. So as far as how have stocks performed? Stocks have actually outperformed quite significantly. And we go back to 2009 when we started this chart. So we started this in June 2009. That is essentially that quarter. The quarter right before is the quarter that we saw that turn, which since then we saw the major improvements in the market. And you'll see the U.S. stock market has had a real unbelievable run-up since that time period. You'll also see the developed international stock market had a really nice run-up, and emerging market stock. But what do you take from here? Essentially, what we see, and a lot of our models are pointing to, is that the real opportunity for individuals over the next couple years is more so on the international side. Developed international has recovered somewhat. Emerging market has recovered somewhat. But you can see that they are still trading at values that are much lower than the values we're currently seeing in the U.S. stock market. So when we look at our portfolios and we're underweighting or overweighting in certain asset classes, one of the asset classes that we are overweighting in the clients where it's the right fit. It's not right for everybody because there is definitely the concern of additional risk of investing in international. But for those clients where their risk tolerance matches up very well with having international equities in their portfolio, we're actually overweighting, particularly in emerging market stocks as well as developed international. Now, why are we concerned about putting all our eggs in one basket and putting all our money in U.S. stocks? This is the reason why. We do feel like international is important for a well-rounded portfolio. And this is a chart that really explains to you why that's so important. The rally that you just saw in the previous chart in U.S. stocks, it really has significantly outpaced earnings growth. In this chart, we put this chart together going back to September 2009. And the blue bar charts, the blue bars show you the S&P 500 GAAP trailing 12 months earnings per share. Essentially, that shows you how profitable are the companies in the S&P 500. How profitable are they? And then the gray line, what that is showing you, is that is showing you the overall performance of the S&P 500. Now, what's interesting, if you look at this chart going back to 2009, you'll see that there's somewhat of a relationship between these two factors. The S&P 500 index level, essentially the price it's trading at, and the S&P trailing 12-month earnings per share, they're very similar. So that as you see earnings per share increasing of certain companies of the whole basket of companies together, as you see earnings per share go up, you also see the growth of the stock market and the value of the stock market go up. Now, however, we have a unique situation occurring. If you look towards September 2013, December 2013, March 2014, and June 2014, you're going to start to see a decoupling of that relationship. That's a fancy way of saying that the stock market continued to march on upwards. However, earnings per share, while they've gone up, they've not gone up at the same pace. This is one of the reasons why we believe that, yes, we expect more positive returns from the stock market, but just not of the same magnitude that we've seen over the last couple years. This is one of the pieces that we're definitely looking at as well. So a lot of individuals have been concerned about inflation. And essentially, inflation expectations have stayed within a range of about 2 to 3% over the last decade or so. There have definitely been periods where that is not true, in particular financial crises. But as far as what we are worried about going forward, it's not so much inflation. We expect that the measures of expected inflation over the next 5 years, we don't see this as something that really concerns us, although I know that it's something that you hear a lot about on CNN or CNBC, Nightly Business Report, but for where we are at, we don't expect this to have a significant role going forward. So what does all of this mean for our client portfolios? What does this mean for you? This gives you an idea of where we are tactically weighted right now versus what we might do in what we call a neutral market. So the strategic allocation, which is the first column that you'll see, that strategic allocation is what we would invest in a neutral market. So a neutral market would be where we would not be necessarily overweighting or underweighting in certain areas. And you'll see next to that our current tactical weight right next to that. This essentially shows the changes that we've made to truly take advantage of this market. So let's start from the top. We have our investment grade bonds. Typically we would have 40% of our money in investment grade bonds. And what we have done is that we've actually moved our investment grade bond exposure. We still have 17% in those bonds, but we have added more diversification. Multi-sector bonds, 7%. Absolute return-oriented bonds, almost 20%. Why is this important? This is important not so much for today, but for the future. We know that going forward, interest rates will go up. They have to. We're at rock bottom historical lows for interest rates. So when interest rates rise, the relationship I spoke about when we first started the call is what's going to happen. When interest rates rise, bond prices fall. Essentially, you lose money on your bonds. Now, there are ways to protect your portfolio. There are types of bonds that you can own that are less sensitive to interest rates, but yet still give you the wonderful benefits of bonds, of having fixed income, of having more security in your portfolio, and essentially having an airbag to your portfolio to take and really absorb the ups and downs of the stock market. And that's why we have been so significantly focused on making sure that our bond position for clients is less sensitive to interest rates and making sure that we have a broad diversification among the bonds that we do hold. With larger cap stocks, you can see we typically would be at 30%. Based on that same story that we just talked about of concern about going forward with U.S. stocks, that the growth that we've received and the wonderful frothy returns that we've had are not necessarily expected to continue at that same pace. So we've brought that down to about 26%, about a 4% change. Smaller cap stocks, ideally we would be investing about 6%, and this is again a more moderate portfolio, about 6% in small company stocks. We're only at 2%. We're only at 2%. And why is that? U.S. stocks that are small cap tend not to do well in times of uncertainty. If you see a downturn, the companies that are most heavily impacted, most significantly, are those that are small company stocks. Why is it? There's many reasons. But part of it might be because they have fewer product lines. They have less access to capital, so less of an ability to go take a loan from their local bank. And they have less money that they have in reserves. They often are much leaner operations and don't necessarily have a couple million just sitting in cash. So this is another area. What we've done is to trim down because we don't necessarily expect small company stocks to outperform over the next couple years. Now, this is the next story. The next story is the developed international and the emerging markets. You can see developed international, we've got about 10.5%. Emerging market stock, we've got 13%. So we've overweighted in those. And between the two, we're very excited about our exposure. We would like to add more. But our biggest concern in adding more exposure to international is not whether or not we're going to get the returns we want. It's more so about you, the individual investor. Every portfolio that we create has a risk-loss threshold. That risk-loss threshold is a promise. It's a promise that we can't always keep, but it's a promise to try at all times to keep the portfolio within a certain range of returns. And so portfolios that we have, depending on what portfolio risk it is, might have a risk-loss threshold of 15%. That means in any 12 months, the portfolio should not lose more than 15%. Others we have at 10%, 5%. We even have some risk-loss thresholds below than a 5% loss. For those clients who really, just like me, don't want to lose principal. They don't want to risk that. They're not ready to put that type of risk in their portfolio. So every portfolio, we do keep that in the back of our mind. So while we would love to overweight our international exposure even more, we know that international has more risk, and we need to be smart about it. And in the market downturn, we've made a commitment to making sure that everything we could possibly do to keep each portfolio within that risk-loss threshold, that we abide by that. And then finally, we have alternative strategies. Alternative strategies are very unique, wonderful investments where we can invest for a client and have additional diversification in the portfolio. Our arbitrage strategies are not necessarily impacted by the stock market going up or down, and we like that. And let me tell you why. No client is going to complain if their entire portfolio goes up together, all lockstep, both international, domestic stocks, as well as bonds. But we here at Francis Financial, that causes us a lot of concern. The reason why that causes us concern is because if everything can go up together and is correlated to go up together, then guess what? It can also go down. That's our biggest concern. Do you want your entire portfolio going down in the event of a downturn? No, we don't want that either. And so alternative strategies are very important for us. Alternative strategies, just so you know, they often are thought of as an investment that you have to hold. You cannot get out of. They're not liquid. These are wonderful alternative strategies where clients can get their money back anywhere between 1 to 3 days. They're liquid. You can sell them the same day. It really is a wonderful kind of best of the best situation for clients. We don't believe in locking up clients' money without you being able to access it. No one wants that. So this gives you a little idea of more of a more moderate to aggressive portfolio that we have, giving you some of the ideas of the actual asset allocations. And again, this is different for every single client, and many of our clients we've overemphasized different asset classes. We have some clients in financial services where you won't see any financial services in their portfolio. Other clients, we have very much of a socially conscious focus and specific screens to screen out certain companies. essentially every portfolio is customized for our clients, and it really is lovely. With 100 clients, that's something that we can definitely do. Talks a little bit about the small cap, and again, why we're underweighted in small caps. Essentially, small caps are very much overvalued relative to larger caps. And currently, the small cap PE ratio is about 21%, and that's much higher than the premium that we're seeing on large caps. So, and historically, what we've seen as a premium on small caps is about 3%. So us being at 21% over that is quite significant. So that's something why we're, again, steering away from small caps. As far as our equity allocation is slightly tilted towards more global stocks. Even within the pieces that we have, we very much try to focus it more towards emerging markets as well as international. And this is the reason why. Why do we expect international to do so much better? Here I'm showing you the global share of GDP in our first chart at the very top. Emerging market economies account for about 50% of growth, GDP, whereas developed market economies like the United States, the UK, that accounts for the other 50%. And what's really interesting is when we look at the below. When we look at the below and we look at the chart showing global market cap, almost 90% of global market cap is owned by developed countries. Only 10% is really owned by emerging markets. So what does this mean? Emerging markets essentially makes up 50% of the global GDP, but only 11% of market cap. And we believe that the significant discrepancy is going to narrow significantly as emerging market fundamentals, they continue to improve over the long term. And why do we expect emerging market fundamentals to continue to improve? Well, there's a lot of reasons. They've got a lot of wonderful tailwinds to help them be successful. The first of them is that they have a relatively young population, whereas here, us in the United States, we have what's called an aging population. The younger population helps lead to increased productivity, higher per capita income, greater GDP growth than we've even seen. And so as this happens, we expect that emerging market countries are going to see that gap narrow between their share of GDP, the share of the growth of their economy, versus the market cap. And with that, you're going to see their stock markets go up. So this is just a really unbelievably compelling story and why we are so excited about investing in this part of the country. As far as the bond story, I spoke about that previously to give you a little bit of a snippet of why we are being so smart about our investments in bonds. So here I'm showing you the Vanguard Bond Market Index. That's the area that's all the way to the far right of this chart. And how you read this chart, essentially on the left-hand side, your distribution yield, so the yield for that holding. And along the bottom is your interest rate sensitivity. And the interest rate sensitivity shows you that the Vanguard Bond Market Index is actually extremely, extremely sensitive to interest rates. You can see it's almost at a number 6. The number 0 shows that it's not in any way sensitive to interest rates. Well, the Vanguard Bond Market Index, as interest rates went up last year, that index actually went down. In fact, it was the first time since 1999 that we saw our bond market indexes, particularly the Vanguard Bond Market Index, lose money. It was quite significant. Now, we don't invest in that bond market index because we don't believe it gives us enough protection against interest rates rising. And so this chart shows you some of our holdings, and we invest in some others, some more heavily than others. But what's important, I want you to take a look at this, the T. Rowe Price floating rate, the DWS floating rate, the FPA New Income. These are all really interesting bond holdings that we have that you can see have very, very high yield, which we love, and actually very, very low sensitivity to interest rates. So this is something that we're continuing to watch, which we're really excited about in really protecting the portfolio to make sure that you have the bond exposure you need, but at the same time that you're not going to lose money, because no one wants to lose money from bonds. So I know that I've gone through a whole lot here. I ask you to stay in touch, and I've given you my email, phone number, our Twitter handle, Facebook, our website. We'd love to hear from you. I know that you really want to have information that's tailored just for you. That's what Francis Financial is all about. So please reach out to us. We are offering a second opinion review, a free second opinion program that we are offering to all of our friends and family of Francis Financial. So if you are looking for another second opinion about your portfolio, reach out to us. 80% of Americans would appreciate a second opinion. Just as you always want to get a second opinion before a big surgery with a doctor, we know that with something as important as your portfolio, having a second opinion about your portfolio is something that you should be doing too. There's no charge, and in the second opinion service, you will get a phenomenal 10-page survey talking about the entire portfolio that you currently hold. We'll let you know, number one, if it's perfect, if we wouldn't change a thing, and stay the same path where you're going. Number two, we'll let you know if there are certain tweaks that you should be making and give you suggestions on how to make those with your current advisor. Or three, looking at it and really seeing that it's not a portfolio for you. It's not the right fit. Being able to give you broad and very also specific suggestions on the portfolio, how to change it, and also letting you know that we can help you make those changes too. So whether you're just curious or you've been worrying about the ups and downs in your portfolio quite a bit, please do reach out to us about our second opinion service. Well, thank you very much. Have a great day. We appreciate you being part of this wonderful call, and know that we're here for you. Francis Financial. Plan, grow, protect.